Hello everyone, in this video I'm going to show you 3 different techniques to help hedge your positions in the stock market. The last thing you want is to suffer crippling losses like in this stock Hyliion, which a lot of us like, but it's down 45% in 30 days. So how do you avoid these big losses? Well, today I'm going to show you 3 techniques, very easy to learn, and that's a crucial skill you need to learn for the future if you're going to be investing in the stock market. So let's get started right now. Alright guys, let's begin with the first easiest strategy, which is setting up stop losses for your stock positions. So when you set up a stop loss, you're telling the computer, so your brokerage, to automatically sell your shares if the share price drops to a certain amount. By doing so, you're going to protect yourself against severe losses because if, unfortunately, the share price drops below where you set up your stop loss, automatically it's going to trigger and then your brokerage is going to sell your shares. So you'll collect the money and then you'll be out of the position, meaning that you won't suffer extra losses past where your stop loss triggered. So the biggest strength of this strategy is just how easy it is to implement and how it protects you from the downtrend. So I'll show you an example in a minute where literally in a few seconds I'm going to implement one, and that really gives you a lot of peace of mind knowing that you have a limited potential loss. So I'll give you an example now. Let's say that the stock price is at $25 and you set your stop loss at $22.50. Well, ahead of time you manage your risk because you know that if the stock price drops by 10%, then it's going to trigger and then you'll be out of the position. So you're going to be able to avoid those crippling 30, 40, 50% losses, which a lot of us have suffered in the past, and you guys know how painful that is. So let me give you a live example in my E-Trade account. Now, every brokerage lets you do this, but they all behave a little bit differently, so I don't know how yours work. You'll have to figure it out. But they all allow you to do this. So this is a stock called TRNE, Trine Acquisition. I have 700 shares, currently at 1065, and it's not doing that well. So let's say that I'm starting to lose hope on this stock, and I just want to have that downside protection because I don't really trust it anymore. So what I'm going to do is I'm going to open a sell order on it, right? And then in the quantity, I'm going to list the amount that I want to have the stop loss. So it can be your entire position, or it can be just a fraction of your position. Let's say that I change this to 500, right? Oh, not 5,800, 500. Let's say that I do that. Well, then if it hits that price, the stop loss, it's going to sell 500 shares and then I would keep 200. Maybe I figure, well, I'll just let those 200 shares ride. Now, in price type, you would do stop on quote, and then in stop price, you would write in the price where you want to have the stop loss at. So let's say that I do 1040, and they're currently the stock price at 1065. That means that I would have, in theory, that 25 cents in downward risk. Anything below 1040, I'm going to be out of that position, so I won't suffer those losses. As a bonus, I'm going to show you another stop loss that not a lot of people are using, but is very effective at protecting your profits and again covering your downside. It's called a trailing stop loss, and it can be either a specific amount of money or it can be a percentage. So either or. So the process is the same as the previous one, but instead of doing stop on quote, you're going to do either trailing stop dollars or trailing stop percentage. So in this case, let's do dollars, and let's say that I want to do a trailing stop for 25 cents. So I do 0.25, and how it would work is that as the price of the stock goes up, well, the trailing stop loss is going to follow it and again have that 25 cents gap. So eventually, when the stock stops going up and starts going down, as soon as it goes down by 25 cents, it's going to sell automatically. Now, 25 cents is a little bit tight to it, but let's say that you have a stock that's going up a lot, like Hyliion did, where it went from $10 to $58. Well, let's say that you had a $5 stop loss trailing. Well, as it got to 58, then the stop loss would have been at $53, and then once it reached back down to 53, you would have sold automatically and you would have kept all of those gains. Sadly, of course, no strategy is 100% perfect. This stop loss does not work all the time. The biggest flaw to it is that it does not protect you from overnight losses. So let's say that we go back to our example earlier. You have a stock that is at $25 and you set up your stop loss at $22.50. Well, let's say that after hours there are really bad news, right? They miss their earnings or something really bad happens, and then in the morning the stock opens at $20. Well, you won't have triggered at $22.50. It's going to trigger at the open on whatever price your broker is able to get for your shares. So you're not going to have that $2.50 downward risk. So as you can see, it's not a perfect scenario. It's better than not having any protection, but it doesn't cover you 100% of the time. Another weakness that I have to mention about stop losses is that they are very vulnerable to short-term panic selling. So this is Facebook. If you guys remember, a few months ago, there were talks that advertisers were going to boycott the platform. And then what happened is the stock price went from 245 all the way down to 206. But this was very short-lived. If you had a stop loss at 225, you would have saved that money from 225 to 206. But people very quickly realized that this was not going to affect the stock long term. And because of that, it rebounded and recovered very quickly, went up to $300 a few weeks later. So this is not a case where you would have wanted to have sold your stocks automatically. You would have had to have thought about it yourself and made up your mind, right? So the stop losses are great. It's better than not having any protection, but it's not foolproof. There are times where it's not going to work in your favor. So because of that, you have to monitor them. And once in a while, right, you can have those events where it's going to catch you by surprise. But of course, it is easier to rebuild your position after an event like this than if the stock had continued to drop, right, and had gone down to 160 or something like that. So you have to understand the strengths and the weaknesses. This is one of the weaknesses. Every once in a while, it's going to catch you, but most of the time, it's going to work in your favor. As an example of DraftKings, this is the perfect scenario where the stock went from 64 and now it's at $43. Well, if you had a stop loss at 55, you would have saved $13 in downside, right? And eventually you could have rebought a position. You could have just thought about your strategy and gone from there. Moving on to strategy number 2, buying put options, which is a much stronger hedge than just setting up stop losses. When you buy a put option, you're entering a contract with another investor where if the price of the stock drops below a certain price, you're going to be allowed to sell it to them for that price. So let's say that the stock price at 25, you would get a put option at 23. Well, if the stock price drops to 22, you can sell it to them for 23. If the stock price drops to $1, you can still sell it to them for 23. So you're guaranteed to have that downside protection. Of course, if the stock price stays at 25, then you lost the premium that you paid for that contract. So the benefit is that you have a very strong hedge and you're protected if the market drops suddenly and sharply. But for that protection, that insurance, well, you have to pay a premium, which you give to the other investor. That's their risk, right? That's the money they collect to assume that risk. And that can be fairly expensive if the stock is volatile or if the market assumes that there's going to be some negative catalysts. So let's say that you have earnings coming up. Well, often the volatility is going to increase, which is going to make the options more expensive. And then when you buy your puts, it's going to be more costly for you. So that is a net negative. This only helps you when the stock drops sharply below the strike price where you bought your put options. So for a live example of buying put options, let's look at Tesla, which is currently at $420. This is a very volatile stock. I'm worried that it's going to drop, so I want to get some protection. Well, the first thing I'm going to do is look at the expiration dates. So you'll see them at the top here. You can buy this put option for a couple of days out, a few weeks, a few months, or even 2 or 3 years out. The longer the period, the more expensive the put is going to be because you have that insurance for a longer period. The shorter period you're going to look for, the cheaper it's going to be because that insurance is only going to cover you for a few days, a few weeks, or maybe a few months, right? So the shorter period, the cheaper it's going to be. So if I look a month out from when I'm filming this, right, let's say that I want to get that protection at $410. I don't want to have to sell my shares anything under that. So I'm going to go to $410, which is the strike price, right? And then currently to buy that option, it's going to cost $22.60 per share in premium. That's the money that I would pay to the other investor, right, for them to give me that option. Well, since one contract is 100 shares, to buy that contract and get that protection, I would have to pay $2,260 upfront to get that protection. So that would make sure that if the stock price drops under $410, then I'm allowed to sell it to them for that price. But in exchange, I have to shell out $2,260 upfront. So it is very, very expensive for that protection. This is mostly good when there's a falling knife scenario, a black swan event like in March when the pandemic hit and all of the stocks really, really crashed. This would have saved you a lot of money. But in general, right, as you can see, it's so expensive that it doesn't always make sense, especially in stocks that are very volatile. If we look at something a little bit more stable like SLV Silver, right, another stock that I often invest in, well, let's say that currently the stock price is at 22.94. I just want to cover myself in case there's a big drop. Like if it only drops by 25 cents, I'm okay. I'm not going to lose a lot of money. But what if it loses 10 or 20%? So we'll look really like a little bit further out. Instead of looking at 22.50, which is the closest strike price, let's look at $20. Well, now it could only cost me 8 cents per share out of 22.50, right? So it would be a lot less expensive and it would cover me in case there's that black swan event, like something happens and it really drops very, very quickly. Well, then I would have that protection and I would be able to sell at $20. So you guys can see, like, it really helps you when the stock crashes. But if it's just regular, normal day-to-day movement, then often it's just too expensive. It's just going to eat you alive. All right, and now our final strategy, selling covered calls. So previously we were buying options and paying a premium. In this case, we're going to be selling an option and collecting premium, and that premium is going to offset some of the losses when the share price drops. So when you're selling a covered call, you're giving someone the option of buying your shares for a certain price. So for them, it's a bullish strategy, and for you, it's a neutral to bearish strategy. So you're going to be collecting premium, which is going to lower your cost basis. Let's say that you bought a stock for $25 and you're collecting a 50 cents premium for giving someone the option of buying your shares at $25. Well, now if the stock price drops to 24.75, right? The share price dropped by 25 cents, but you collected 50 cents. So now not only are you going to be keeping your shares because the price is under 25, which was the strike price, but also you're up 25 cents. So your cost basis is at 24.50. Now the share price at 24.75, so you're ahead by 25 cents, even if the stock price dropped. If you weren't selling covered calls, right, you would have suffered a loss of 25 cents. Seeing it visually is going to help you understand a little bit better. So this is DraftKings. As you can see, it's in a clear downtrend at $42, and recently it was at $62, meaning that if you didn't do stop losses, if you didn't buy puts, and if you didn't sell covered calls, you would have taken a $20 hit, meaning that you would have either suffered losses or lost a lot of your profits. This is a textbook perfect case where selling covered calls is going to be the perfect strategy. So if you look at the options window, you can see that for the November 6th expiration date, and then at the strike price $43, to sell this contract, I would receive a premium of $2.75 for each share, meaning that I would collect $275 for one contract of 100 shares. What effect does this have? Well, if you look at the graph, you can see that the current share is $42.74. Well, this shifts the break-even point to a lower amount. In this case, 42.74 minus 275, so 39.99. That would be your break-even point where anything above that you'd be ahead, right? Let's say that it's at $41, then you keep your shares and the premium. But if it goes below 39.99, that's when you would start to lose money. So you lowered your cost basis. Now, in a case like this, let's say that the stock price went to $36. Then you would have losses from 36 to 39.99. So this is why I was saying that it's not a one-to-one perfect ratio. It's not a complete foolproof loss mitigation strategy, unlike buying puts or just having a stop loss. But it just gives you that padding, making it so that your losses are reduced and you're collecting that cash as the equity goes down. I know exactly what you're thinking now. Patrick, what happens if the share price recovers? What if DraftKings goes back to $50? I don't want to sell my shares for $43 after holding the stock for months, and I want to hold this stock for 5 years. Well, here's what you have to understand. Number one, we're selling covered calls on stocks that are going sideways or going downward. We're not going to sell covered calls on a stock where the chart looks like this and it's going straight up. This is not the way to do it, right? For a stock like this would be a good period when it's trending down, and this when it's trending sideways, this would be a great period. But when it's going straight up like this, you don't want to be doing covered calls. But still, it is possible that there can be a reversal, right, and it goes back up. So what do you do then? You don't panic. The first thing you want to do is look at what your break-even price is on the upside. In a case like this, it's going to be your strike price plus the premium that you collected. So since you already have it in your account, if the share price goes up, you can use that money to close the position. So let's wrap up with a breakdown of this scenario. On the low side, your break even is going to be the share price minus the premium that you collected, so $39.99. The high side is going to be the strike price plus the premium, so in this case, $45.75. Now, what happens with different prices? Let's say if the share price ends at $42, then you're going to be keeping your shares because it's all or nothing. It's under $43, so you get to keep the entire premium plus your shares. Now, what happens if the share price goes to $45? Then you're going to close the position, so you're going to keep your shares, but instead of keeping the full premium, you're going to be keeping 75 cents, right? The strike price plus 2, and then you'll pay that $2 to close the position, and you'll keep the 75 cents. So in a case like this, the buyer of the option overpaid for the option. It didn't go up enough for him to break even, right? That's why I like selling instead of buying options. Now, the last case is, let's say that it goes up to $48. Typically, if you monitor it over time, right, you're not going to let it go to $48. You're going to close your position before that. But let's say that there was a huge event and overnight it goes to $48. Well, then you would be down a little bit on your covered calls. Your share price would have gone from 42.76 or 74 to $48. So you would be up $5.26 on the shares. But on the covered calls, you would be down $2.25 to keep your shares and close the position. I hope that makes sense. That wraps all of it up. These three strategies are crucial if you want to be in the stock market long term and limit your losses. And I use this last strategy to generate income on a weekly basis. So I hope this video helps you guys. If you have questions, I'm sure you will, please write them in the comments. I'm going to answer all of them, and I'll do follow-up videos in the future. So like and subscribe. In the future, I'm going to do more videos like these. If you like this type of information, just let me know. Thank you. Have a great day.